We're live on the other platforms. Good morning, everybody, or afternoon. I guess it is now 2 p.m. Eastern time. We are going to react here to the FOMC meeting. Going to share my screen with Telegram. I'm live streaming on Telegram, also on YouTube for Bitcoin and markets, and Twitter for Rogue Macro. So check out all the links for those. All right. So what you are seeing right now is the FOMC calendar. I'm going to refresh. It is out. So let's take a look at the statement. In support of its goals and in light of the shift in balance of risks, the committee decided to lower the target range for the Fed funds by 0.25%. So that's exactly what we were expecting. That's what I've written about multiple times now, talked about here ad nauseum on the live streams. And we expected this. That was what was priced in by Fed funds futures. The Fed is once again not surprising the market. They are doing as they're told, as they have been instructed to do by the Fed funds futures. And that is what we got. So a lot of people, like to think that the Fed sets interest rates. They set their own overnight rate, but that really doesn't control the market. Let's go and take a look at the chart here. So I want to, 1 second, I'm going to bring up the 3-month. And guys, I plan to continue streaming until we have the press conference. So like this if you're watching it on YouTube. Retweet if you're watching it on X. John Delaney, what's going on? Dex Invictus, what's up? What's up, guys? So 3-month, what do I want to look at here? This, okay. Share this tab. And we do have my indicator of Fed funds policy. Oh man, it's all messed up here. Let's see. We want both of these to be red and the inside to not have color. All right. So you can see the 3-month priced in that cut last time. It also was pricing in this cut. We just got an update there, a little bit of a jump. I was saying if we were watching this 3-month and it started diving more and more, by the time that we had this FOMC, that's the market pricing in 50 basis points, and the Fed would cut 50 basis points. We've seen this before. If we go back here to last year, their first cut in September, you can see it really started diving down before that first cut, telling the Fed, hey, you better cut 50 basis points. And then they did. Really probably should have cut 75 that first time. They went a little bit less than they probably should have on that first cut. But in essence, what we're seeing here is the Fed following the yields down, and they are doing that again here. So everything exactly as we expected to happen with the cut. Let's take a look at Bitcoin to see how it is responding. So Bitcoin and gold we'll take a look at. 111.5. Not a very good day here for Bitcoin. It looked like it was going to try to go back higher, back up to all-time highs and, quadruple tap, try to get out of the 120s. But the last couple of days we have sold off. If I bring the 50-day moving average up, you can see we rejected right off of that 50-day moving average pretty cleanly. Okay, how about gold? Gold is up slightly on the day, but, let's go down to the hour, see how it is responding to this news. Not really much exciting stuff going on. How about the dollar? Now, my theory is with rate cuts, we will get a strengthening of the dollar. That seems really weird to most people, but it is signaling support, accommodation, and higher economic activity. When you have higher economic activity, you want more dollars to partake in more economic activity, whatever. And so the dollar should rise in that situation. Most people think, oh, if they're cutting rates, they're debasing the money, which they're not. They are trying to be accommodative to the market, which should mean more economic activity. That's the way they think about it. How about the oil? No, I wanted to look at S&P 500. And there we go. Not much of a reaction right now. We could go down to the 5-minute and see what's cooking down there on the 5-minute. A little bit of volatility. You can see some big wicks. Looks like it kind of wants to go down. Remember, the initial reaction usually is reversed by the end of the day. Right now, I'm not seeing any big initial reaction even out of this market. Once again, we continue with this really weird market. Everything is just blah right now. One thing that we looked at on the live stream yesterday, that was just on Telegram. So if you guys are watching on YouTube or Twitter, make sure you join the Telegram as well. I did put it up as a video version onto BTC Market Update channel. But we talked about this weird environment that we're in right now. We looked at PMIs, we looked at copper to gold ratio, we looked at a few other things, and just how blah it has been. There is no evidence of cycles. Like if we bring up ISM PMI, okay, I had to wait for it to think. My streaming is making it go slowly. Oh, it's because I need to go out to the month. Okay. Stand by 1 minute, guys. All right, that was embarrassing. My son's friend came to the front door and I had to go let him in. Okay, so what were we looking at? PMIs. Yeah, just look at how weird this market has been here. So PMIs kind of are proxy for or signify the business cycle. You can see above this line, which is 50, we are in expansion, and below this line, we are in economic contraction, at least as surveyed from this large group of purchasing managers. Okay, and you can clearly see the business cycle here until we get to right here in the last couple years. Where is the business cycle? It's like a kind of just weaving its way a little bit higher, a little bit higher. And when we take a look at the Bitcoin chart, we kind of see that same thing, right? We got these big bumps and then just a straight line. It's really weird. So we're experiencing this on many different levels, all around. Pretty much every indicator you look at from a cyclical point of view, like that has to do with business cycles or whatever, it all has this really weird. Okay, now I'm frozen. Okay, my computer is glitching here a little bit with all this streaming, but yeah, we just get this really weird tail on pretty much all of these cyclical indicators. But anyway, okay, let's go back to the FOMC and read through some of this while we're waiting for the press conference. It'll be at 2:30. We did not get a summary of economic projections. If we go back here, you can see last meeting in September, we got a new SEP. That's in the projection materials that they show at the press conference. And that comes, let's see, 4 times a year. So almost every other meeting, but kind of skip a little bit around here. But yeah, so we did not get an SEP. Let's go and just read the statement and see what kind of sense we can make of this. Let me check comments. before we do that. Okay, you can't see anything? What? Why is that? Oh, you guys want to know why? Because I had to select the other screen. So let me quickly go through this for those guys on Telegram. Sorry, you heard the audio, but you didn't hear this. So I'm going to switch back, go through these again. No reaction in the markets. I'm talking about the PMIs here. So if we went to ISM, PMI, I'm not some expert streamer here, guys. I'm just a guy. Here we go. So ISM PMI, you can clearly see the business cycle really deep here during the Great Financial Crisis, way even deeper than COVID, right? Because they came out with that all the stimmy checks and the stimulus that really saved this. So purchasing managers didn't really see as deep of a chasm as it had here for the Great Financial Crisis. But you can clearly see the business cycle. But what happened here? It's just like a weird tail, slowly kind of going up, maybe coming positive. Some people are expecting it to be like, let me make sure, guys. I told you I'm not an expert streamer. Let me make sure this is coming through on both places. All right. So some people are expecting, a business cycle, PMI to do that. But for that to happen, there needs to be actual growth, actual good economy. PMI is not going to turn around and go positive without actual economic growth and progress. But we're in this era of deglobalization. Demographic decline is starting to bite in places like China and Japan and even Germany and Italy. And so we're in this really weird place. Are we going to have a business cycle? And if Bitcoin is connected to the PMI, correlated, what happens if this doesn't? What happens if it just goes like this? That's the business cycle this time. What does that mean for Bitcoin and all the other assets, gold and all that stuff? We don't know. But that's what we're watching. So we're seeing this kind of weird tail on all of these cyclical things. All right, now let's go back to FOMC. And I won't forget to send Telegram over there too. Sorry, guys. Let me do that. There we go. All right. FOMC statement and we will listen to Powell here at 2:30. I'll make sure to pull up that video. So available indicators suggest that economic activity has been expanding at a moderate pace. Now, this is true if we look at GDP. Let's go to GDP now. Okay, so this is Federal Reserve Bank of Atlanta GDP now. These are estimates. The latest estimate was October 27th. And you can see where it is. Almost 4% annualized for Q3. Of course, we're in Q4 now, but Q4 should come, or Q3, the first estimate should come out by the end of the month, I think on the last day. And then a revision comes out a month later, and a second revision comes out a month later. Then we'll get fourth quarter in January. But so this is showing about 4%. So when the Federal Reserve says that they are seeing economic activity expanding at a moderate pace, I would say that's true. It's weirdly true. It's weirdly true because we have multiple things like layoffs. Amazon, UPS, all these big companies just announced major layoffs, Facebook. But we have GDP expanding at 4%. We have the copper to gold ratio, which is another one that we've looked at recently. And I'm writing a blog post about all of these cyclical things put together. But the copper to gold ratio, which symbolizes or signifies if gold is outperforming and this ratio is going down, because it's the denominator and gold is going up relative to copper, that's flight to safety. Okay, that means that the economy is doing worse. If this ratio is going up, that means copper is gaining relative to gold, and copper is a industrialized metal. It's very highly correlated with economic activity and growth. So if we're having higher copper prices relative to gold, that's positive environment. We are at record lows. Let me pull that up while I'm at it. Let me pull that up. Let's see. HG1 is copper futures. Let me get that over XAU USD. Share this tab with everybody. Make sure all right. So I've been doing some work with this. The copper gold ratio is at record lows. If we zoom all the way out here, on record, this trading view goes back with these specific tickers. It goes back to 1988. And you can see we're at a record low right now. That means the worst economy, the strongest gold relative to copper on record. If we bring up recessions, so US recessions, we can see that recessions happen on the way down or at the bottom here in COVID. But, we could have classified this as a recession a little bit back into 2019 and stuff before COVID. I've talked about this a lot. We were going into recession, you could tell, from 2018 into 2019, and then COVID happens. Then we get a little reprieve from all the stimulus in this copper gold ratio, but we've trended back down again. So where is the recession? This would tell us that a recession is imminent. Copper is the weakest on record to gold. Recession is imminent. But that's not what we were talking about with the PMIs. We're showing the PMIs going up, and so many people expected PMIs to rebound, and we see GDP at 4%. What's going on here? This is a crazy market. And I'm not afraid to say it. A lot of analysts will try to come up with some answer for this right off the top of their head. And of course, they're going to be wrong. I'm not big enough to try to pretend that I know what's happening here, but something major is going haywire in the global economy. Is this associated with deglobalization like I've been talking about? Is this associated with all of these other things that I have been talking about in my pre-recession and my evolutionary monetary theory, all these stuff about evolving back into sound-based money? Is that what we're kind of seeing here? It starts to fit a little bit, doesn't it? All right, so that's copper to gold. Let's go back. FOMC. Make sure I'm sharing with Telegram as well. Let's see who's in here. I need to watch the chat better because Joachim said hopped over to Twitter. Okay, cool. Sorry about that, guys. I think I can remember now. Let me see if there's any other comments. No. All right. Let's read through this statement a little bit more. It is 2:20. Press conference will start in 10 minutes. Job gains have slowed this year. We just talked about all those layoffs. And the unemployment rate has edged up but remained low through August. Last meeting, Powell said multiple times in the press conference, he was like, we have this really weird situation where the economy is slowing down, but the unemployment rate is not taking off. So, usually they want to balance their monetary policy, or maybe fight inflation a little bit more, or uh, be a little bit more stimulative, or whatever. They want to balance these and use their tools to manipulate things, at least try to manipulate things. But they're in this really weird situation. And so that's kind of what this is saying. Job gains have slowed, but the inflation, really, the CPI and PCE, they haven't really come down the way they want the Fed. The Fed wants them to. More recent indicators are consistent with these developments. Inflation has moved up since earlier in the year and remains somewhat elevated. I don't want to really get into all this. Maybe we'll talk about it a little bit later, but there are multiple ways to measure prices. If you use a different methodology for shelter, we're down at 1% year over year. And these aren't just like fly by night different measurements for shelter. It's like if you use industry standards like Redfin and others, okay, if you use other types of measurements for shelter, the prices year over year go down to like 1%. It's just the particular way that the CPI and the PCE work in their methodology that's keeping these year over year numbers higher, keeping shelter elevated. Okay. The committee seeks to achieve maximum employment and inflation at a rate of 2%. Now, of course, inflation means money supply. They don't count the money supply, so they have to use a proxy. That's why they use prices. And usually supply of money will be closely related to prices, but not always. Prices go up and down for multiple reasons. All right. Uncertainty about the economic outlook remains elevated, to say the least. The committee is attentive to risks to both sides of its dual mandate, and judges that downside risks to employment rose in recent months. Okay. So let's see what they decided to do with quantitative easing or quantitative tightening. The committee decided to conclude the reduction in its aggregate securities holdings on December 1st. So they're going to continue to let things roll off their balance sheet until December 1st. I think that might change before December 1st. We'll see if we get there. We'll see what happens when we get out of October. It's just been a really weird month for all markets, I think. Okay. That's it. So checking comments. Dex or John Delaney, if you have any comments, feel free. I am going to go check over on Telegram. And let's check Twitter too. Hey. Okay. Don't want to get feedback on that one. All right, guys. So let me pull up YouTube and the press conference. If you have any questions or comments, put them in the chat and we can talk about them. It is 2:25. We got 5 minutes for this. Let's jump back into the chart and just look at a few. Yeah, that's the press conference's background noise. And we'll go back down to an hour. Little bit of a bounce here, but selling off again since the FOMC. Gold going down. Let's take a look a little bit more at gold. A lot of people are talking about gold bouncing. I don't think so. I mean, you can see these few days right here. They were bouncing off of this most recent kind of support from back here. Let me make sure I've got that shared everywhere. Again, guys, I'm not some expert streamer. Okay, so here, these days got some support. This was I drew this line on here probably at the beginning of this big down day that we had for gold. And we did find support there for a while, but then we broke through it. Now, almost testing the bottom side of this line. But if we bring up the 50-day moving average, I think that's where we're headed. At least the 50-day moving average, if not all the way back down here to 2,500, guys. We're Bitcoiners, or maybe looking at different charts, so we're kind of used to moves like this. This was extremely euphoric for gold bugs. And remember, we went over Brent Johnson and what he said about this. If you looked at the central bank's reserves, people were talking about how gold overtook treasuries. That was simply because of the price movement. If you look at actual tonnage, it has gone up about 5% in 5 years for central banks. So that's about 1% a year, roughly. It's not like they all of a sudden started stacking a whole bunch of gold or anything. It was just, this was a speculative mania. I think it was a squeeze, perhaps, of like commercial shorts or something like this, market makers. And the top went really, really high, and it's not going to be able to sustain that. We'll see if the 50-day moving average can stop it. If not, it's going back and going to try to fill this gap right here. We do have a gap right on this breakout. It's a beautiful runaway gap that's just begging to get filled. And I think it will. I think it will. So that's gold. What time we got? 1 minute. Check out some of these. Now on the 10-year, we might expect a little sympathetic. Oh. No. I thought the music had changed. Okay. We might expect a little sympathetic bounce. That's what happened here. So when the Fed cuts, the market says, are they going to be able to increase growth and inflation expectations? Is that going to happen? Maybe. No, it's not going to happen. And then it dives, it continues its fall. So now we might expect something similar. Are they going to be able to stimulate? Is this going to work? No, it's not. So see, that's kind of what I'm expecting. Continued weakness. All right. I think we got it everywhere. Got Powell coming up to the mic. Jay Powell, welcome.
Good afternoon.
Afternoon.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although some important federal government data have been delayed due to the shutdown, the public and private sector data that have remained available suggests that the outlook for employment and inflation has not changed much since our meeting in September.
That's a good point. The government shutdown has delayed things. It was going to delay CPI, but that came out late because Trump recalled them and said, go get that out. So the unemployment numbers and things like that, payroll numbers, those are all delayed. But I agree with Powell that it doesn't seem like anything's changed.
Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by 0.25 percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments.
So how soon before they start QE? They won't call it QE. They'll call it something else. I think it's pretty likely to start by the end of the year. I think we'll get at least one more cut, and we'll probably get the resumption of some new facility that it's going to be QE, but they're going to try their best not to call it QE. I think that has so much stigma attached. And the way that they think of it, because they are market manipulators, trying to nudge the market this way or that way. Stigma is very important. They want to stay away from stigma. So, for example, if you're a bank that goes to the discount window, there is a stigma attached to that. People are like, "Ooh, what's going on with Bank Jim Bob over there? He's in some trouble. He's going to the overnight window." So there's stigma attached to that. And they don't want that stigma. So they come up with these other facilities. And they say, okay, well, you can take advantage of this new funding overnight, not stressful at all window facility. And there's no stigma attached to that because it's a brand new facility. But then on the next cycle, that has stigma now attached to it. And so now they have to come up with a new facility and a new name, even though it's pretty much just going to be QE by another name. I think that probably can happen by the end of the year. We'll have to wait and see. So one more cut and maybe a new program by the end of the year. That might happen. That might not happen. Usually through the end of the year, we start, people actually spend for holidays, and there's more travel, there's more economic activity. And so we don't really see a lot of stress forming after October into the end of the year. That's one of the waves that Bitcoin and stuff can run on. So we might have to wait until Q1. And the end of Q1 is another bottleneck. That's when we saw Signature Bank. That's when we saw Lehman Brothers. So end of Q1 is another big crunch point. And that might be when the new facility comes out. The new facility came out with the Signature and Silicon Valley banks, that regional bank scare a couple years back. So we'll probably, that would be a good time to see a new facility come out for the Federal Reserve and do like shadow QE.
Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, Most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.75% to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effect.
That's a political statement. If you guys know my stuff, one of the things, tariffs are a tax. Even though the administration will say it's not a tax, it's not a tax. Tariffs are a political weapon, and the Federal Reserve should have no business dealing with the fallout of the politics of things. So, for example, if you raise a tax on gasoline, say 50 cents a gallon, to raise money for the government and maybe to disincentivize more use of gasoline, you are doing that tax to get a political goal, And the Fed has no business trying to interfere with the outcome of policy, of political policy. They should not even think about tariffs. That's my opinion.
On inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in months, the balance of risk shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance.
That's important phrasing there. So, they in their mind, they are restrictive. So if the neutral rate is 3.5% and they were up there at 4.5%, they are restrictive. They can cut 4 times to get to neutral, right? So a cut in that respect can be still hawkish in a way because it remains above neutral. So that's how he's trying to pin it. We're lowering rates to help the job market, but we're still restrictive, which should also help against inflation. So he's trying to play both sides.
With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. We continue to face two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions. Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing repo facility.
This is one thing that Nick Bhatia has been hitting out of the park, coverage on this.
In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been
Joachim says that you don't think that they are thinking about tariffs. Well, he explicitly said, remember when they paused rate cuts for 9 months. The reason why he had paused is because he said that there were risks to inflation from tariffs. So the tariffs were specifically in the reasoning for the pause in the first place. What was he mentioning to preempt the journalists? Yeah, I'm sure he's trying to get just say reference my comments, but all right, let's continue.
been shrinking our balance sheet. Our securities holdings have declined by $2.2 trillion.
Yeah, in the spring and throughout the whole year up until September, the reason why they weren't cutting was because they were had uncertainty over the effects of tariffs, and that was explicitly the reason was tariffs.
As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury securities.
Eric Jones says on YouTube, surprised Q4 bull so tame so far for BTC. Yeah, me too. Was mentioning that earlier about how the market is just so weird right now. I saw that it's going to be one of the bigger expirations here for Bitcoin futures and options and stuff at the end of October. It's like 15 billion. So we'll see if we rally at the beginning of the month in November, kind of like we did in October. But yeah, it's been very, very tame. We'll see what happens with gold. We'll see what happens to that copper to gold ratio. And overall, one thing I did not show was the Russell 2000 to Bitcoin. Let me see if I can bring that up real quick and show people. Is it this one? Okay, let me see how do I share this? Okay, sharing it with Telegram. Now let's share it with you guys. There we go. Okay. So Russell 2000 and Bitcoin. I saw this, I think it was yesterday or the day before, and it just blew my mind. So on the Russell 2000 on the bottom here, when it breaks out of its previous consolidation, it's exactly the same time Bitcoin breaks out. Each time, like almost to the month, it breaks out. And what's happening right now on the Russell 2000? It's breaking out. Bitcoin is right there with it, wanting to break out. Very weird market. Okay, let me see if I can replace back with the Federal Reserve, FOMC. Got it. All right, let me see any other comments. Nope, let's go.
This reinvestment strategy will help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned two goals for monetary policy. maximum and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand our actions affect communities, families.
Okay, we'll fast forward to the questions. Joachim says, tariffs can have economy-wide effects on unemployment and growth. For example, I don't think they were thinking about tariffs as prices go up or a threat to their inflation target. Okay. I almost feel like he shouldn't have brought up tariffs at all because it brings him into the political sphere. Like we talked a couple months ago or a couple meetings ago about how the Fed is losing independence, right? The Treasury is trying to take over. The Fed is losing independence. Well, the Fed kind of put themselves there by talking about tariffs. They were talking about policy, and they were talking about it in a negative way, right? That it was affecting their path of rate cuts. It was affecting the Fed. The Fed was changing their policy due to political moves. And I think they kind of brought this on themselves in that way. If Powell would have never mentioned tariffs and just continued, right, with his rate cuts, or continued didn't cut rates but didn't blame tariffs, kept his nose out of the political sphere, that maybe it wouldn't even have snowballed into what it definitely would not have snowballed if they would not have paused rate cuts. Like the ECB continued rate cuts all throughout the year. The Fed paused after December last year because of worries about tariffs. So if they would have just shut up about tariffs and continued cutting with all the other central banks, they eventually continued here, right? But they stuck their nose in the political, they let politics interfere with their policy. That's my belief. And they brought it on themselves. And this is going to continue. They are squarely in the political camp now. They've mentioned too much about politics, too much about tariffs. They should have just kept their nose in the non-farm payrolls and the PCE. That's what they should have done. Come up with some other reason to pause rates, not tariffs. They brought it on themselves. And this could be good. I mean, all of us here, in alternative macro or Bitcoin, whatever, we kind of want to end the Fed, right? So if they lose their political independence, if they lose their independence, that's kind of like one step towards getting rid of the Federal Reserve. But be careful what we wish for, right? Because what is going to replace the Federal Reserve? It's not going to be free banking. It's going to be the Treasury. And are you ready for inflation? Because that's really going to be inflation if the Treasury takes total control. I do think the independence of the Fed guarded against a lot of inflation. Once the Treasury takes over, major inflation. That would almost be like forcing us to adopt a Bitcoin standard immediately. So the loss of independence of the Fed will kind of parallel with the adoption of Bitcoin. So it could be good depending on how you view it, right? But I'm just kind of making commentary on how I see this market developing. And I think the Fed brought it on themselves by being political about tariffs. And, rational minds can differ on this for sure. Point says, yay, we're dumping again. Let me see. Let me see the chart. All right. Bitcoin 110.4. My goodness, people. That meme where what hodling looks like, what hodling looks like and what hodling actually is. Man, this is it's been rough. Bitcoin cannot get a footing. I mean, yeah, we're hitting all-time highs. We were just at all-time high back on October 6th. So now, I mean, this month we hit an all-time high, but barely. I mean, we're basically at the same price we were in December. In December, we hit 108. And we're at 110. It's very frustrating. All right, back to FOMC, and we'll fast forward to the questions. Did someone ask one already? Oh yeah, Nick Timrose, right there. We were right there.
Nick Timrose, Journal. Chair Powell, are you uncomfortable with how market pricing has assumed a rate cut is a foregone conclusion at your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So I would say that needs to be taken on board. We had, I would just say this, 19 participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our two goals, we have, strong views across the committee. And as there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And, we're going to be looking at the data that we have, how that affects the outlook and the balance of risks. And I'll just say that.
You and some of your colleagues have framed last month and maybe today, I won't put words in your mouth, there's a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook, or could this unfold along the lines of last year where you made a sequence of adjustments and then waited to gather more information?
So the way we have been thinking, I've been thinking about it is the risks to the two goals. For a very long time, the risk was clearly of higher inflation. And then that has changed now. And as we saw particularly after the July meeting, we saw the downward revisions in job creation.
That's not me messing with the mic. That's somebody there in the room.
We saw a very different picture of the labor market, and that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a, I would say modestly, other people would say moderately restrictive level, needed to move more in the direction over time of neutral. If the two goals are sort of equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management. And I would say the same about today, sort of the same logic. But as I mentioned, going forward is a different thing.
Claire.
I'm Claire Jones, Financial Times. Thank you for taking this question. We've just heard from you that the discussion in December and the conclusion of the decision, not a foregone conclusion. I'd like to that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth through rises in stock price related to the AI boom? Thank you.
I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other. And they also have different levels of risk aversion. And some will be more averse to inflation overruns, and some.
I feel much better about this cut than about the last cut. I thought they were getting behind, and maybe that was because of that was the middle of September. We're going into the end of Q3, which is the biggest bottleneck of the year, and it felt like they were behind. And the way he was talking about it felt like they weren't prepared, maybe is the right word. So this one I feel a lot better about. I do think that the economy, we were just looking at some of those different things like the PMIs, the copper to gold, and how they're disagreeing, which is very odd. We see unemployment rate starting to go up. I've seen reports, though, that these layoffs from these big businesses are mainly due to automation gains. So UPS and Amazon, they're automating a lot of these systems, and so they don't need as many workers. It's not that they're struggling; they're actually doing fine, but they're laying off people because they just don't need them. They're like changing up the employment, the labor for automation, and so it's kind of leading to this weird point where we're not booming and we're not busting. We're just kind of going sideways. And I think that this cut is also very representative of that idea. So I feel much better about this. I feel much better. Who cares what I feel about it? But I think it is makes much more sense now than it did in September. That's for sure.
Some will be more averse to underruns of employment. And so you put that together, and as you can see from the SCP and from the public discussion that goes on between the meetings when participants go out and talk, they're very disparate views. And they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that, that we haven't made a decision about December. I always say that. It's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just ask a quick follow-up on QT? How much of the fund impressions we've seen in money markets are related to the U.S. Treasury issuing more short-term debt?
That could be one of the factors, but the reality is we've seen, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, what the place we're trying to reach. What we said for a long time now is that when we feel like we're a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened. Some things have been happening for some time now, showing a gradual tightening in money market conditions. Really, in the last, call it 3 weeks or so, you've seen more significant tightening. I think a clear assessment that we're at that place. The other thing is, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice, and so there's not a lot of benefit to be holding on to get the last few dollars because, again, with the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So, there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
Colby.
Thank you. Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from 2% target, seems to be, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second-round effects from tariffs?
Yeah, I mean, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, that would certainly play into our decisions going forward. So, and we do have, we get some data. The labor market is a place where we get, for example, we get the state-level data on initial claims, which are sending a sort of a signal of more of the same. We also get job openings, and we'll get lots of survey data. We'll get the beige book and things like that. So we'll have a picture of what's going on in the labor market, and the fact that we're not seeing an uptick in claims or a downtick really in openings suggests that you're seeing maybe continued very gradual cooling, but nothing more than that. So that does give you some comfort.
Again, really
But
weird.
if the shutdown lasts a while
market.
longer and you don't have that data in hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December?
Yeah. So we get like I mentioned what we get in the labor area. We get some data in inflation, some data in economic activity, and we'll have a picture of what's going on. We also will have the beige book again. I would say we're not going to be able to have the detailed feel of things, but I think if there were a significant or material change in the economy one way or another, I think we'd pick that up through this. So in terms of how it might affect December, it's really hard to say. December's the meeting's like 6 weeks away. We just don't know what we're going to get. If there is a very high level of uncertainty, then that could be an argument in favor of caution about moving, but we'll have to see how it unfolds.
Steve.
Steve Leisman, CNBC. Mr. Chairman, can you characterize the meeting in terms of, you said strongly differing views. Was this a close call, this cut, or was it a close call maybe the other way because you had dissents on both sides? Thanks.
So I was referring to the discussion about, to the extent related to December. You saw we had 2 dissents, one for 50 and one for no cut. So that was a strong, solid vote in favor of this cut.
Interesting. They had 2 dissents. So one voting member wanted 50 basis points. Ooh. And one wanted 0. That's interesting. I'm pretty sure they're going to cut in December.
The strongly differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity. Forecasters generally, broadly, have raised their economic growth forecast for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's not clearly in motion. It's not clearly declining quickly in any case. It may be just continuing to gradually cool. And again, people have different forecasts and expectations about the economy and different risk tolerances. And so there's you read the SEP, you read the speeches, there are differing views on the committee, and to the point where I said what I said.
Just to follow up on the balance sheet, if you stop at the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percent of GDP and become a tightening factor?
So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in Treasury bills, which will foster both a more Treasury balance sheet and also a shorter duration. So that's what. In the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow.
Okay, that's important. What did he just say there? Because if he's adding more bills, that can be adding stress to the system. Hold on.
So that the balance sheet doesn't shrink as it become a tightening factor?
So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in Treasury bills, which will foster both a more Treasury balance sheet and also a shorter duration. So that's what. In the meantime, if you freeze the.
Yeah, so he said Treasury bills. So he's talking about the really short duration, and those are what are the most liquid. So in the market, in the shadow banking system, in the Eurodollar system, you have this web of repo, rehypothecation, interbank lending. And in that, those moves of money have to be collateralized. So usually treasuries go one way and dollars go the other way. The collateral that's most preferred is bills, the short-term things. So you want as many bills out there in the monetary system, in the market, not sitting at the Federal Reserve. One thing that they did back in 2019 that they found out was wrong. I think it was 2019. Let me think. I'm pretty sure that was the event. And they were buying a bunch of bills. And that really added stress to the market because there are periods where off-the-run treasuries, like let's say you have a 10-year bond, treasury bond that is 5 years old or something. That's not very liquid when you compare it to like a 3-month treasury bill. Okay, those are very liquid relative to those older dated 10 years. So you want to have actually the Fed's balance sheet be full of the 10 years and the 30 years and have the bills be out there in the market. That's why the Treasury is doing this Operation Twist that they're doing right now with the Treasury buyback. So they'll issue bills, 1 month, 1 year or shorter. They'll issue those to buy back longer dated. So what that's doing is putting out more short dated stuff into the market, making it more liquid. Now, if the Fed says they're going to be replacing mortgage-backed securities with bills, that's the wrong call. Maybe he misspoke there. He should have probably said Treasury bonds. But anyway, let's continue.
The size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing that has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long. But at a certain point, you'll want to start reserves to start gradually growing to keep up with the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, we didn't make decisions about this today, but we did talk today about.
So what he's saying here is eventually the way the design of the system is, we have to do more QE. Even if we get back to the Goldilocks zone for monetary policy and everything is hunky-dory, eventually we're going to have to do QE because we have to grow reserves commensurate with the growth of the banking system. So that's what he's saying. But they also have to grow reserves if the banking system starts declining as well, because they don't want to decline. Remember, the Fed losing is not 3%, 4%, 5% inflation. That's not the Fed losing. The Fed losing is deflation, runaway hyper deflation. That's what happened in the Great Financial Crisis. That's what happened in COVID, and so that is the Fed losing. And what happens when that when they go through that, they increase their balance sheet too. So if the economy is doing poorly, they increase their balance sheet. If the economy is doing well, they eventually have to increase their balance sheet anyway, because they think they have to grow to have ample reserves in the system. It's kind of a weird thing. It's like the weapon, it's the same weapon no matter what. That's when you know that there's probably some cognitive dissonance going on, when both sides of the coin are fought with the same weapon, and that's growing reserves.
Composition of the balance sheet, and there's a desire that the balance sheet be right now it's got a lot more duration than the outstanding universe of Treasury securities, and we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding Treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually.
Mistake.
I don't think you'll notice it in market conditions, but that's the direction of things.
That's a mistake. He's sowing the seeds. He's sowing the seeds for a problem, for illiquidity. If they are going to be shortening the duration of their balance sheet, oh boy, that's not good. They Lord, making the same mistakes.
How are officials interpreting the latest CPI report? So components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on employment or inflation?
So the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation. But we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments. But so directionally, it was a little
Stubborn in services inflation. What are some of the things that the Fed could do to address that, and especially when we're seeing potentially labor supply challenges?
Sorry, say the first.
The stubborn services inflation that you mentioned.
Service inflation. Yeah. Well, again, the part of services inflation that isn't coming down as we would like.
Great, thank you. Gabriel, Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that for all, and could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles?
That's a good question. I've written a lot about this, talked a lot about the AI bubble. My latest feelings on the matter are that it is a bubble, but I think the bubble has a lot longer to go. I think we can easily go into 2026. Yeah, bigger bubble. There are some parts of this market that are overbought, but overall, when you look at things, when you look at individual names, we're not overheated. So the AI bubble can continue, but that's interesting that he is talking about the AI bubble as driven by loose policy. I would say that it's a sign of narrowing. So you know how I've talked about in the past that the top companies in the stock market, they get a disproportionate amount of the passive investment, because when you invest in the index fund, it's something like 8% or 9%, whatever NVIDIA takes up gets 9% of that, all of that. And the bottom 400 companies they have to split 1%. And so it's disproportionate. It's a narrowing of where the money goes. Also, for credit in particular, in good times, credit, the application of credit. So credit going to X, Y, Z in the economy. That broadens out because everybody's doing better. There's low risk. The economy's growing. There's ample growth out there to support a broadening application of credit. In bad times, what happens is credit gets narrowed. Okay, credit gets narrowed because there's people, segments, industries having a hard time. Like if you look at the shipping industry right now or transportation, terrible. It's going through a very, very hard time right now. So there's industries that are going through hard times, and so they don't get as much credit. The credit goes into more narrow applications. Right now, when it's very narrow onto AI companies, that signals to me that the economy is overall bad. And for a while, that can work because AI investment can spill out into other things, right? It's the secondary effect. But as that bubble continues on, and towards the end of that bubble, you start getting less secondary redistribution and more narrowing, continue to narrow into one single sector or one single industry, and you get a blow off top, and then you get a recession after that. So narrowing into AI is a sign that the economy is weakening, at least with my school of thought. Now, let's see how Powell answers this, but that's an interesting question here.
How is the Fed thinking about that?
So I don't think that you're right. There are a lot of data centers being built and other investments being made around the country and around the world.
He didn't want to say bubble.
And big U.S. companies are just investing a lot of resources in thinking about how AI, which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run assessments that this is an area where there's going to be a lot of investment and that it's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
And then just
That's a
quick
great
follow-up.
answer.
You mentioned that you do have data that you're looking at for inflation and growth in the absence of government data. Could
Good
you
job, Powell.
give us a sense? I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data?
So it's a lot of things, and it doesn't replace government data. But you know all of these. I'll just mention some of the many names: Price Stats, Adobe, and others. For wage inflation, there's ADP data. On spending, you're going to ask me at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the Beige Book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think if something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Howard.
Okay.
Howard Schneider with.
This will be the last one, guys.
I just wanted you to elaborate a little bit on what you said a moment ago about the continued shutdown, making it more difficult to make a move in December, and that may make you more cautious. To the degree you are relying on private data that isn't the gold standard, or that you're relying on your own surveys of the Beige Book, do you worry at some point you're going to have to start making policy by anecdote?
This is a temporary state of affairs, and we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it. And that's our jobs. That's what we're going to do. If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that what do you do if you're driving in the fog? You slow down. So that could or could not. I don't know how that's going to play into things. We may get the data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. It's certainly a possibility that you would say, we really can't see, so let's slow down.
As a follow-up in the debate on this meeting, we saw recently some pretty big layoff announcements coming from Amazon and others. Wondering if that figured into the discussion at all, that you're starting to see this tension between growth and employment starting to be resolved, to the detriment of employment. And secondly, some of the stresses starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to be possibly be going up quite substantially, things like that. Has that started to become a factor in your policy discussion?
So those are both things that we're watching very, very, very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs, and much of the time they're talking about AI and what it can do. So we're watching that very carefully, and yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully. But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing or a similar thing. We are, if you listen to the earnings calls or the reports of big public consumer-facing companies, many of them are saying that there's a bifurcated economy there, and that consumers at the lower end are struggling and buying less and shifting to lower-cost products, but that at the top, people are spending at the higher income and wealth, and so much anecdotal data on that, and so we think there's something there.
Edward.
Thank you. Edward Lawrence with Fox Business. So,
Okay,
Mr. Chairman,
well,
I want
this
to
is the
take
last
a
one,
crack
actually.
at the further reduction in rates is not a foregone conclusion. So in December, he said, far from it. So if a cut might not be on the table for December because of lack of data, what does the other concerns then stem from?
Okay, before they answer this question, guys, if you're watching on Twitter, check out the Telegram, also the YouTube. Links should be in my bio for that. If you're watching on YouTube right now, like and comment. Appreciate that. Check out the Telegram. All right.
So if it's not lack of data as the reason December is not a foregone conclusion, what other things could be the concern then?
Well, perspectives of people on the committee that we've now moved 150 basis points, and that we're down into you're into that range between 3 and 4, where many estimates of the neutral rate live in that 3 to 4% area. You're there now. You're above the median number for the committee, but I think there are people on the committee who have higher estimates of the neutral rate, and that's you can argue these positions since it can't be directly observed, the neutral rate. So I think
It can't be directly observed. In other words, it doesn't exist.
for some part of the committee, it's time to maybe take a step back and see whether they're
Neutral rate's a moving target. It's a concept. It's kind of like equilibrium in a marketplace, right? There is no such thing as equilibrium. You're never in equilibrium. You are moving from one place to another. And so that's just like a neutral rate. There is no such thing. And if there were some neutral rate, it wouldn't be at a round number like 3.5. It would be like 3.542 or something like that, right? It would be much more precise. But no, the neutral rate is dynamic, moving concept that we can never actually achieve.
there really are downside risks to the labor market, or see whether, in fact, the growth, that the stronger growth that we're seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read. So people just have, again, we've cut 50 more basis points in the last two meetings, and there's a sense like, from some, let's pause here, kind of thing, and a sense from others wanting to go ahead. But that's why I say differing views, strongly differing views.
And so on that division, then you're talking about going forward. So what's more important in this division? Is it inflation risks? Is it employment risk? Or is there a deeper philosophy division among the board?
Look, everybody on the committee is deeply committed to doing the right thing to achieve our goals, maximum employment and stable prices. You have differences on how to do that. And as I mentioned, some of that is different forecasts, but a lot of it is also different risk aversions to the different variables, which is common through,
I get the question. The dual mandate, which side is more risky, and is there underlying philosophy? That's what he asked. Powell can't answer that. There is no underlying philosophy. They have one weapon. I mean, really one weapon, the policy rates. They also have things like quantitative easing and their balance sheet and stuff like that. But overall, it's one weapon at different strengths to apply to polar opposite problems. That's the school of thought that the Federal Reserve is in. That's the school of thought of modern central banks. They're in, their school of thought is cognitive dissonance, the same tool for opposing problems, just maybe a little bit different strength of these two different tools. It's kind of crazy. But all right, that's the last one. Let me see if there's any comments in Telegram. Should have been watching that more closely. 109, guys, for Bitcoin. Come on now. Actually, it's back up to 111 I'm seeing in my browser. Silly flash crash behavior, yeah. Barron says Treasury Fed utility or unity could be an effective way to devalue the debt. Mahler's has been ranting about this for months. Yeah. I mean, eventually the Fed will go away. That's my thinking. Probably in my lifetime, the Fed will go away. It'll probably, I don't know if it'll go away completely or if it'll just be absorbed by the Treasury. Probably won't get cut completely. Maybe an air of independence, less independence, but really it's just the Treasury. So, yeah, and it would be a great way to make big moves. So with the Federal Reserve, they're kind of impotent. All right, they're also kind of at odds with other central banks. At least they were for the last, say, 4 years. So during COVID, you really saw this. You really saw the ECB going towards monetary policy directly for political goals. And like they were going to use their bailout tools to apply to certain industries and not to others based off of climate, based off of their climate zealotry policies. And so you see that politics really creeping in. Now, I just went on a big rant about how Powell has brought this upon himself with bringing tariffs, which are political, into their decision-making process and at least talking about them heavily over the last year. So they kind of brought that upon themselves, but that's less so. I think that's kind of a halfway step into politics where the ECB is full on political. Can't remember where I was going with that, but yeah, I can't remember what my point was. Leverage cleared on the way back up now. Yep. Imagine, DT says, imagine they paused right now. Oh yeah, if they paused, you're saying it could have hit 100K? Maybe. Yep. I think the Fed is they're walking this tightrope and staying on the good side of markets. I've talked about this too, about the credibility of the Fed. They're kind of in a weird spot. Okay, they brought on this political discussion, this independence of the Federal Reserve. Lisa Cook is still at the Federal Reserve. Okay, she's still a voting member. That court case has been delayed. I think the president will end up winning that court case eventually. And so the kind of independence of the Federal Reserve, that topic has been put on the back burner, but it will come back. But the Fed is kind of like, how do we proceed without losing too much credibility, and while we're trying to fight our dual mandate or go, uphold our dual mandate? And the best thing they can do is just go along with the market. It was priced in for a cut. It's good. They're going to cut. Priced in December for a cut. If it remains that way, then they will cut. If for some reason the market turns around and doesn't price in a cut, then they won't cut. They're just following what the market does and kind of filling us in, debriefing us on the back end. That's what it's like. And then I'm examining the debrief here. That's kind of crazy. But all right, let's see any other comments on YouTube, and then we're going to be out here for the day. Nope, not seeing anything. All right, guys, check out bitcoinandmarkets.com. Also, the new Substack is roguemacro.substack.com. Thanks for joining. Make sure you follow, like, subscribe, comment. Wherever you're watching this, do the appropriate things down below. So thank you, guys, and I will see you on the next one. Bye.